In this presentation, we will analyze the balance sheet report within QuickBooks Online. Here we are in our test drive file for Craig's Design and Landscaping. We're going to go into the balance sheet reports now. We're going to do that by going down to the reports down below. And as we've seen multiple times, the balance sheet report is almost always going to be one of our favorite reports. So we see it down below in our favorite reports. But it's also going to be in the business overview. So I want to go down to the business overview. We have different formats of the balance sheet. Here we're going to be picking the famous one or the most popular one, the actual balance sheet. So let's open that one up. Going to change the date range up top to be 01/01/19 to 12/31/19. Oh, that's not what I wanted. 19, 12/31/19. And then we're going to go ahead and run that report. Now, oftentimes I like to have the balance sheet on the right-hand side so that I have two tabs so that I can go back to the other tab if I want to look at data input or some other report. So typically I'm going to do that duplication thing. We're going to right-click on the tab up top. We're going to duplicate that tab, and then it'll actually name the balance sheet up top in the tab. All right, so here we have our balance sheet. I'm going to make it a little bit larger now by holding down Control and using the scroll arrow. I'm going to scroll up so we can zoom into the balance sheet a bit. I'm also going to close the hamburger over here, as they call it, so that we have a bit more space to see our balance sheet. Now, what we want to do with the balance sheet is understand a balance sheet in general, and then we also want to understand the differences between reports in general, including here the balance sheet, of what Intuit might do, which might differ from normal financial accounting or what you might expect in a balance sheet somewhere else. So some kind of differences within the balance sheet are just basically formatting differences. Some of it has to do with the design of the way a certain type of software works. And some of it has to do with basically, the QuickBooks trying to help out users. Typically when they're thinking about the QuickBooks users, they're trying to help out. And you always want to keep your mind to the fact that QuickBooks might be trying to help out to users that are in data input mode, and therefore may not understand the accounting of it as much. And therefore, oftentimes they're going to not work as much with debits and credits if they can. Obviously, debits and credits are always involved in the building blocks of the financial statements. But if they can make it in a plus and minus format, then they'll probably try to do that to help data users that don't know debits and credits. And if they can help tie out the reports in some way, tie out reports like the balance sheet and the profit and loss and see how they're connected, then they may add some features such as that to help see that more clearly, and we'll see that as we go. Now, one of the nice things about the features of the balance sheet, obviously we have the name up top, the balance sheet. Notice the date of the balance sheet is as of December. It doesn't have a date range because we're in a point in time rather than a date range. The date range reports are going to be most of the other reports that are related to profit and loss and activity reports. This is where we stand at a point in time. Now, a nice little feature on the balance sheet for QuickBooks is these little arrows. And if I select the arrow, then I can minimize the information. So what I'm going to do is I'm going to minimize the assets and all the assets and then the liabilities. And that way you get a quick look at basically what the balance sheet is. We've got the assets and then the liabilities and equity. So assets equal the liabilities and equity. Assets represent what the company owns, and the liability represents basically who is attributed to the ownership, either a third party, someone other than the owners, or the rest being attributed to the owner. So these are like two sides of the same coin. That's what the balancing process is. Then we're going to open this up one by one. I'm going to make this a little bit larger and analyze each section of this. So we're going to go into the assets section, and then I'm going to minimize, every category within the assets section so we can think about them one at a time. We have the assets, then we have the current assets and the fixed assets. Now notice when you think about current assets and fixed assets, these are terms that you would use in financial accounting, and they're also accounting types. So that's how QuickBooks kind of knows that where these little arrows are going to go. In other words, if you go back, I'm going to go back to the prior tab, and we go down to the My Accounts, and I look at the chart of accounts. When we set up a new account, when a new account is created, we have to assign it an account type. And so the types are here: bank account, accounts receivable, other, and so on. So those account types, I'm going to make this a little bit larger if possible. I'm going to put my cursor right in between and make this bigger. So here's the account types. Those account types will help with the breaking out and the deviations and the subcategories within the report. So if I go back to the reports, then you'll note that this fixed asset is an account type. The current assets actually have more sub-accounts within it. So if I go into the current assets, Then we have the checking account and the saving account. Those accounts are under the account type of bank accounts. So if I went back to the chart of accounts, those are going to be under the account type of bank type of accounts. And that's how QuickBooks can basically group them together. That's why they have another subcategory here of the bank accounts. And then we have the subcategory of the accounts receivable. Now note, accounts receivable is an account type, therefore has the drop down, but you don't typically see a drop down in a normal financial accounting report. Why would you need a subcategory for accounts that typically only has one account into it of accounts receivable? And the reason for that is because the account type is what's being used within QuickBooks. That's how they're having this little drop down area. And you need a different account type for accounts receivable because it's going to act differently. We're going to have different things we need. We're going to have to trace who owes the company money, that this account represents who owes us money, and therefore it has different characteristics, this accounts receivable account, than other current assets do. And then everything that doesn't fall into bank account or accounts receivable, they put into other current assets. So now we have an account type of other current assets down here, and that's going to include everything else that doesn't fall into a special kind of account type like cash or accounts receivable, which QuickBooks needs to pull out into a separate account type because they want the behavior of those accounts to be different. And so these would be set up as inventory and undeposited funds. That's going to give us the total current assets here, and then the total current assets. So you'll note this basically lines up as you would expect with a normal financial accounting, although you might have some more subcategories given the nature of the account types and how they're basically putting together the account types. Also note that you typically wouldn't have something like undeposited funds oftentimes in the end result of the balance sheet because the undeposited funds is a type of cash and may be grouped together up here in the cash line. And you can kind of see that in the cash line now. You notice you have two accounts here in the cash line. If you were to minimize this, this is more what you would expect to see in a financial accounting report, which would just be called cash, right? Cash would include the checking account, the savings account, and any kind of checks and whatnot that were included. The QuickBooks doesn't have a cash line. They're calling it the account type of bank accounts, right? So that would be a little bit different. You have a little bit of a different terminology, but you can see how you can group you can break the accounts out so you can see the detail. You want to see the detail because what you want to do, what most people do is they would like to go to this report as their main report to then zoom in, as we've seen in prior presentations. Therefore, you want to see all the different accounts. When you do the reporting, however, oftentimes financial statements will not be showing the different type of checking accounts and savings accounts, but group them into one category of cash, or in this case, grouping them into the bank account. You also might see a different name down here. We're going to be down here to the fixed assets. Could be called property, plant, and equipment, or depreciable assets possibly, but they're going to name it fixed assets. In the fixed assets, then we have the type of assets that would typically be like depreciable and land, right? And here all they have is the truck. So the truck is going to be the only item that is included, and they put that in a subcategory. That's going to give us the total fixed assets. Now, oftentimes you'd have depreciation here, accumulated depreciation, I should say, up top. And we'll talk more about that later, but that's going to give us the total assets then. So now I'm going to close the assets up, and let's think about the liabilities and equity. I'm going to open up liabilities and equity, and then I'm going to close everything within liabilities and equity, and let's consider them one at a time. So then we're going to open up the liabilities. Once again, we have the current liabilities. That's standard because those are liabilities that are going to be due within a year typically. And then what's a little bit unusual is then once again, we have these two accounts, a subcategory of accounts payable, and then the actual account underneath it. Why? Because again, QuickBooks needs to account for the accounts payable as a separate account type because it's going to have different functionality within the system. And they're telling the system here to have a sub-account based on the account type. So that's why you kind of have this duplicate thing, which looks a little bit, funny, a little bit different than you might see, but not a problem. And then you got the total accounts payable. Then you also have credit cards. Now, again, credit cards are being broken out here. If you looked at a normal kind of balance sheet that was an in-balance sheet, you might have one account called credit cards that would put all the credit cards together, kind of like this, or they might be grouped in some other kind of grouped into a liability section. But note, if you have multiple credit cards, you would open up the credit cards and you'd have multiple credit cards here. And again, The reason for this is that QuickBooks then wants to be able to use the credit card accounts, let them act differently, and be customized to the functions that you would typically need for a credit card account, and therefore they're going to appear on this end report as their own accounts, and that'll help you to basically be able to use the quick zoom feature and zoom into each of these accounts. Then we have the other current liabilities, and this is going to be, of course, everything else that doesn't fit into one of the special accounts that is another liability account. So if it's a liability account that doesn't fit into a credit card or an accounts payable type of account, then typically, and it's current, then typically we would put it into other current liabilities. And then we have the long-term liabilities, and these are going to be those things that we owe for a long period of time, like a loan payable or a note payable that's going to be due past the current year, and then we put them into the long-term liabilities. That'll give us then the total liabilities down below. I'm going to minimize this one up top then, well, I can't do that. I'm going to minimize the liabilities here, and now let's take a look at the equity. So equity section. Now equity is a little bit unusual just in terms of the name itself, because if you're talking about a sole proprietorship, and you're looking at a balance sheet for sole proprietor, they might call it owner's equity. If you're looking at a partnership, it might be called partnership's equity. If you're looking at a corporation, it might be called stockholders equity. For a QuickBooks, they're going to put it all into equity, and equity again is an account type basically. So when you set up an account, you're going to set it up as, in essence, an equity account. But the names of equity, the types of accounts that will be involved in the equity section, although equity in and of itself is it is what it is. It's assets minus liabilities is equity, kind of like the book value of the company. The name of equity, like we say, will change. If it's a partnership, you'll have different kind of names than if it was a corporation for equity. You might call them capital accounts within there, and the corporation will have something called retained earnings in there. So you can think of equity as a whole, kind of acting the same, but the names of the equity section are often different. If you go to not-for-profit organizations, then it's not called equity at all. It might be called net assets or something like that. So if you go into here, then we got the opening balance equity. Now this account is an account that you really wouldn't really want showing on your report. We're gonna see why QuickBooks uses the opening balance equity account later. But notice it's kind of like a default account. This account's basically telling you, hey, QuickBooks set up something and put it into this account because we don't know what to do with it. It's not really an account you want in the QuickBooks file. It's something that QuickBooks is going to basically set up when it doesn't know what else to do. And we'll talk about when that shows up. And typically you would want a journal entry out of that, and we'll show that later. So this is something that's not normally on you won't see this on a financial statement, opening balance equity in the balance sheet section. It's not something that you would typically find in QuickBooks either if you were to close it out, because QuickBooks is basically using it as a tool to help you to set up the balances, and then it's something that you probably would want to close out if you want to make your reports look more professional. Then we've got the retained earnings. This is the name for an equity account that would typically be used for a corporation type of equity account. Again, if it was a sole proprietorship or capital or a partnership, it might be called capital or something like that. And that really couldn't depend on how the file is set up. But again, it'll act in a similar fashion on different types of organizations as well. In other words, this is the account that the retained earnings or the income will roll over into. Now, you'll note that there is nothing in retained earnings right now, and this is where the really kind of different thing is on QuickBooks, and that is that they have this other account down here called net income in the equity section, and that you won't find on normal financial accounting. You don't put net income typically into the equity section. Now, the reason QuickBooks is doing that is basically to help people to see how the income statement, profit and loss report, is tying into the balance sheet. So let's take a look at that by looking at the profit and loss report. We're going to go back to the prior tab. I'm going to go to the reports down below, and then we're going to run the report. I'm just going to take this from the favorite reports up top, and we're going to be running a profit and loss report. Let's take a look at a profit and loss report. I'm going to scroll back up top, change the dates from 01/01/19 to 12/31/19. Then I'm going to run that report. And then take a look at the bottom line of the profit and loss report, which is going to be the net income. All the way down here is at 164246. And is that what's in the net income? I hope in the balance sheet. It's the 164246. Yes. So that's how the two tie out there. Now that can be kind of useful to see, but at the same time, if you're talking about a partnership or something like that, you'd like to see it rolled out, or you'd like to be able to roll it out to the multiple capital accounts that it's going to roll out to. Notice in this situation, in a normal corporation, you wouldn't see net income here. You'd see it already rolled into retained earnings. And because there's only 1 year of data, there's nothing in retained earnings right now. But if there's multiple years of data, you'd have something in retained earnings, and then this would typically be rolled into it. So to see that, I'm going to look at the first day of the next year just to see what happens here. I'm going to raise the date 1 day to go January 1st. What's going to happen is this net income is going to disappear, and it's going to roll into basically retained earnings. And that's pretty much the closing process happening for QuickBooks. QuickBooks is doing the closing process, closing out the temporary accounts, the income statement accounts to the retained earnings account. So let's do that. We're gonna take this from 010120 to 010120 and then run that report. Let's run that report and scroll on back down into the equity section down here. And you'll see now net income is empty, and retained earnings is now has that 1,642. So what really happens in generally in a balance sheet report is you never see the net income won't be there. It's already going to be rolled into equity, and you just got to kind of know that equity section includes basically the net income that rolled into it. So that's going to be basically the format. I'm going to scroll back up top. I'm going to go to 010119 to 123119. And we're going to customize that. Run that report, and then scroll back down. So that's going to be basically our income, our balance sheet. Now note that we do have some kind of formatting issues here, and some of the formatting that you can look at if you wanted to change the name on some of these items. Then you can do some of that within QuickBooks. You can go in here, for example, and look at the headers and change some of the names there. However, you are restricted to change some of the names down below. Like you can't really change the assets section, or you can't really change the categories which are driven by the account types. In other words, you can't go back over here to the accounting section. If I go to the accounting and I go to the chart of accounts, you can't change the names of the actual account types that are here. You have to use what's given, and those account types are what are driving the subcategory. So you can't change the accounts receivable subcategory, or you couldn't call the fixed asset accounts property, plant, and equipment if you preferred that name. And you can't really remove the net income number down here unless you change the date, right? It's going to be there if you want it in retained earnings. You can't really move it up, and you can't really change the equity section, this name of equity, because it's an account type. You can't really change that to owner's equity or partnership's equity or something like that. However, you can export this report to Excel and make those types of changes if you so choose. And there are changes that you can do in QuickBooks, including, like we say, changing the header and some other types of customization to the report as well. And that's what we'll talk about in future presentations.